All right, let's bring in our panel now and talk about the market close. Andrew Slimmon is a senior portfolio manager at Morgan Stanley. Melissa Brown, a managing director of applied research at Qontigo. Nice to see you. Melissa, we'll start with you. Your company measures the volatility that we're seeing in these markets. Is this the fasten your seatbelt phase of this flight, and how long do you expect it to last?
I think we're probably at the fasten your seatbelt phase, perhaps not quite at the add the shoulder harness part. So we certainly have seen volatility go up. It has not reached levels that we've seen in other major crises. So, but certainly it's up enough to really be noticeable, and I think start to cause concerns on the part of investors.
And Andrew, when you have a market this volatile, what used to be traditional safe havens seem to be shifting from day to day. Where do you see the best way to position a portfolio right now?
Well, I agree with the previous speaker that I do think the volatility is higher. I think we've had an intermediate low in mid-March, but I'm not sure the low for the year is put in yet. So I think it's more about controlling risk than what sectors, and it means making sure that the risk profile, the beta of your portfolio is not too high. So there's a place for technology or financials. They're both higher beta, but I think you got to offset that with utilities, some REITs, maybe insurance companies that are lower beta, staples, things like that. I just don't think we've seen the lows for the year. I think that'll come, later in the second quarter or into this summer.
Melissa, I'm wondering, given the volatility that you're anticipating is going to continue in these markets, what clarity or what signals do you think investors should be looking for when we potentially might get that bottom for the year and when we might have some of these headwinds to markets getting cleared up?
Well, we would expect to see the volatility start to come down before we get to the bottom. And so that would certainly be one clear signal. We pay a lot of attention to investor sentiment. So looking at kind of the kinds of stocks they're buying, as we just said, are they buying the staples or the healthcare or the other defensive stocks? Are they buying large cap stocks as opposed to small cap stocks? Are they buying higher dividend yield? Those are all signals that investor sentiment is very risk averse. And so another thing that we would look at is a shift in that. Is sentiment, are investors starting to tiptoe into more risky types of names, whether it's by style factors or by sectors?
Andrew, you mentioned we have not yet seen the bottom. How much of that has to do with the Russian invasion of Ukraine? And given that, oil prices and inflation, would you expect a bigger pullback at this point?
I do. I think that regardless of what happens in Ukraine, we got an inflation problem in this country, and the Feds admitted they need to move more aggressive. And I don't see those inflation numbers coming down until second half of the year, and that means we've got some more ugly prints. And a very simple rule is equities don't do particularly well when you have inflation running at these numbers. So until those numbers come down, I don't think really what happens geopolitically, even if there's, God, we all hope there's some good resolution. If there were, I still think we've got an inflation issue that's going to weigh on the market. So I just think that, there's another leg down. And I'll give you a great statistic. During, going back to 1950, we've had 18 midterm years, is a midterm year, and the market has bottomed in the first quarter only once in those midterm years. It traditionally bottoms in August. And I think, kind of that could be a similar setup this year.
And Melissa, as you were mentioning technology, sort of trying to factor in where to sort of put your money at a time like this, we are increasingly seeing, and you agree in your notes, that tech is no longer a monolith. So in terms of the tech stocks that you're perhaps looking at and the ones perhaps people are rotating out of, what is catching your eye right now?
Well, we certainly know that there's a shortage of chips. So if you're a chip maker, you're probably doing well. But if you're a chip user, if you use chips as an input, I think those stocks are not doing nearly as well. Related to the Russia-Ukraine war, or perhaps not, we're also seeing cybersecurity firms, which fall into the technology sector, doing well. But the point is that, as you just said, tech is not a monolith, and so we are seeing, very different performances depending on the business that the company is in.
Andrew, how optimistic are you that the Fed is going to achieve the soft landing that it's targeting? Are you in the camp that we do get a recession amid this Fed rate hiking cycle?
Not. I'm not in that camp. Look, I can see that the 2-year to 10-year is flattening, but I caution people getting too over the skis about that, because the average period from when the yield curve flattens to the market peaks, which is in front of recession, is 2 years. If you look back the last inversions, not the most recent one. That's the first thing. Second of all, it's very unusual to have a recession 2 years after the previous one. Thirdly, there's other yield curves that are sending a different message. The 3-month to 10-year is not inverting because the Fed's only begun to raise rates. So I think we have an inflation problem in this country, but I don't think we have an economic recession problem. And I think those are two very different. So I think what the message, to answer your question, is the market is saying the Fed has leeway to raise rates. And I think a lot of the inflation is COVID related. Wage inflation, supply disruptions, not all, but there's a lot of COVID related inflation. And as the economy reopens and the year over year numbers, right, we measure inflation based on monthly year over year, we're going to have high numbers starting this summer. I think those numbers will come down, but for now they will look ugly. And that's why I think there's another leg lower, but I don't think the Fed is going to spiral the economy into a recession, which is why I do think that when the dust settles at the end of the year, it's not going to be a terrible year for equities. It's just all the return is going to come in the second half of the year.
And Melissa, the same question to you on the likelihood of a recession. And if you see the Fed raising rates, will it have the impact on inflation that some are expecting? Or to Andrew's point, is this more about waiting out COVID?
I think that the increasing of rates will have an impact on inflation. But as Andrew just said, it's going to take a while. Even if prices did not go up at all, from this month to next month, you still have, because we do measure it year over year, we're still going to have many months of kind of eye-popping inflation numbers that we haven't seen in a really long time. And I worry a little bit more about the psychology of that, and could that possibly drive a recession, as investors say, start to get really nervous and have to actually shift their spending.
We'll have to leave it there, but a big thank you to our market panel today. Andrew Slimmon, Morgan Stanley's Investment Management Managing Director and Senior Portfolio Manager, and Melissa Brown, Managing Director of Applied Research at Qontigo.